Okay, let's go. Good evening, everybody. Thank you for taking the time to join this webinar. I hope you can hear me clearly. This webinar will be recorded and you can ask a question via the Q&A and we'll get to it at the end. The agenda is to talk about markets in 2021 and 2022. A lot of material to cover. I hope to keep this webinar under 30 minutes, but I am capable of going off on tangents, but let's try to keep it under 30 minutes. Okay, let's go. Oops. Right, 2021 is a snapshot. Bonds bad, stocks good. Quality bonds underperformed, and that's represented by some negative returns on the major bond indices. So you're looking at the Barclays Global Aggregate Bond Index was minus 4.7, and that's the sort of main global bond index. And global equities were very strong. We've got the S&P at plus 29%. We've got the NASDAQ at 28% for 2021. This exceeded our expectations. We were optimistic about equities in 2021, and we were cautious about bonds. Now, the losses on bonds came from rising interest rates, the rising long-term interest rates in about February and March. When interest rates go up, long-term interest rates go up, then bonds come down. Interest rates went up from about 0.7 to about 1.7, which is a very lot. And because of that, bonds were negative for the entire year. They recovered some of it, but not all of it. And when we have a year where one asset class, stocks, have done exceptionally well, and one asset class like bonds have done terribly, we get a lot of questions from clients when they look at their portfolio and the numbers are unexciting, right? And there's a very strong reason for this, because you can't compare a multi-asset class portfolio to a single asset class index. Everybody wants those high returns from the US stock market, but that wasn't the mandate. We had to operate within the mandate, and we had to allocate money to bonds. We were aware about the possibility of rising interest rates. It wasn't obvious last December that interest rates were going to go up. We were still in the midst of Corona. We still are. Remember, Europe's in negative interest rates. So it wasn't obvious that interest rates were going to spike, but they did. They spiked from around about February, and we had some losses. So my appeal to you guys, or it doesn't matter who your asset manager is, if you're going to compare your 2021 performance to anything, you need to make a simplistic or a complex, an appropriate benchmark. You take a bond index and you take a global stock index and you merge it based on your mandate, and that will give you a rough idea of where your portfolio should be. And then in that context, you'll be able to understand your 2021 performance a little bit better. So jumping a little bit more into those indices, I'm going to read the numbers on the right. So I mentioned US equities have done exceptionally well. MSCI World Global Equities is 19%. That's about 55% USA. The rest of the world obviously hasn't done so well as the USA. Tel Aviv had a very strong year, plus 31% in shekels. For the first time in a long time, the Tel Aviv Stock Exchange was more like USA and less like Europe. For many, many years, the Tel Aviv Stock Exchange behaved like the European stock exchanges, and we never saw such a strong positive year. China, minus 23%. We had some exposure there. I'll talk about China in a bit more detail later on. Global bonds, as I said, minus 4.7 for the main global bond index. That's pretty painful, especially for conservative clients. Treasury bonds, this is government bonds. These things are never supposed to lose money, but because of rising interest rates, there was a negative return of 2.5%. Gold minus 7%. Those of you who have watched some of my previous webinars, for a long time, I've dissed the theory that gold and inflation are linked. This proves it very clearly. In a year when inflation is the highest it's been since the 70s, and to have -7% on gold, that says it right there. Having said that, I would rather, if I'm going to decolorate my portfolio with a highly volatile asset, I'd much rather gold than Bitcoin and other cryptos. So we can talk about that later too. Israeli corporate bonds did very well, +7%. Hedge funds, you know, the old saying that hedge funds give equity-like returns with bond-like risk, that never happens. Hedge funds was a little bit, was okay, a little bit disappointing, but not great. Some of the hedge fund, there's a much wider range of performance in the hedge fund world. And there's lots of different indices too, so it gets confusing. Okay, so excuse the spaghetti here for a second. The blue line is the global bond index that I mentioned. The white line is the global stock index that I mentioned. You can see a very clear trend in the white line trending up, but lots of volatility. Okay, so when your financial advisor says to you, we expect volatility, you can see these up and downs and what it means. The blue line is the bond index, and this is 1 year time frame. So this period here, I don't know if you can see my mouse, I hope you can. This period here is sort of February, March, quite a steep loss in bonds, recovered, and then lost a bit more. But you can see that how volatile it is. Also on the stock side, you can see here how volatile, and for years, clients have been telling me the stock market is overcooked. It's going to be a crash. And you can just imagine the conversations. Stock market comes down here sharply. Client says, I told you so. And then it recovers. Client is quiet, comes down again. I told you so. Client recovers. So it was definitely a year to buy the dips, but you can see how volatile it is. And I expect this to continue. So you can't judge in 2022 and going forward, you can't judge your performance based on 1 month or even 1 quarter. We're going to have lots of volatility, okay? There's lots of reasons for that. And you can just see here how volatile that is. So that's why that graph is there. That begs the question, if I talk about bonds struggling to produce returns and losing money on something that is core to a portfolio, it begs the question, are bonds dead, right? And absolutely not. I've heard this phrase before, bonds are dead, but they're not dead, because then capitalism would be dead. Bonds are a bigger asset class, especially if you include government bonds. It's a bigger asset class in terms of money than equities, but yields are low, right? Yields in US dollars, yields in shekels are very low. Yields in euro, forget about, they're disastrous, but they're very low. And this is before you've paid asset management fees, before you've paid taxes, and more importantly, before inflation. So it's very difficult for a private client to accept the expected returns on bonds, okay? However, ironically, it's the largest component of a private client portfolio. There's different attitudes to balance asset allocation. We see here in Israel, we see different backgrounds and whatever. So an American typical balanced portfolio is 60% equity, 40% bonds. European or Israeli, more risk averse, a typical balanced portfolio is 30% equity, 70% bonds. The South Africans on this call that I know very well, in rands, you've never bought a bond in your life. So you're 100% equity, and on your global portfolio sitting in South Africa, you're a bit more conservative. So you're somewhere between the American and European attitude towards asset allocation. Doesn't matter what your background or what your asset allocation, we've got a huge chunk of the portfolio that's not going to produce interesting returns, and it's not going to protect us from inflation going forward. So it's a big dilemma, particularly for conservative investors. You must be asking the question, why would we bother with bonds in the first place? So bonds have the advantage of a much narrower range of outcomes compared to equities, right? Yes, there's some uncertainty with bonds, but the range of outcomes is much narrower than equities. Equities, you can lose. 2008 equities were down 50%. Bonds have never been down 50%, right? So minus 5% on that global global aggregate bond index that I showed you, that's like a huge number relative for bonds. And let's just explain that for a second, how that happens. There's 3 major risks for bonds: credit, the company doesn't pay you back; duration, which is your interest rate sensitivity. because it is a fixed cash flow. And then liquidity, the ability to sell it. And if you can't sell it, then your bid offer spread widens hugely. So in order to understand how the bonds are affected by rising interest rates, because you've all heard that interest rates are going up, and it's in the newspaper, and the Federal Reserve even announced it, that next year interest rates are going up. And then the question is, why do we hold bonds? So the Federal Reserve set the short-term interest rates, and our bonds are more exposed to the longer-term interest rates, which are set by the market. Okay, how the market is going to respond to higher short-term interest rates is a bit of an unknown. I do believe that interest rates are going to stay relatively low forever. And for the balance of my career, for sure, I think interest is going to stay relatively low, simply because there's too much debt in the world, and they cannot possibly, the governments cannot possibly service, I think it's $20 trillion US government alone of debt, and we're going to be paying the bill for Corona for a very long time. So how the market's going to respond is a little bit unknown, but the Federal Reserve increasing interest rates in the short term is not the issue, in my opinion, that we should be concerned about. Just to present that graphically, this green line is what we call the yield curve. The x-axis here is time. The far right-hand side is 30 years. The far left-hand side is 1 month. These are how much interest rate you would get for that time period. So you can see on 1 month, it's close to zero. At 1 month, it's close to zero. And if the Federal Reserve increased those interest rates on the left-hand side there, that's not going to really affect our bond duration risk. The area in the red circle, the red oval there, that's the area that concerns us. That's where interest rate, that's where we suffered in 2021 because interest rates went from 0.7 to 1.7, somewhere around here. So this is the area where we could feel the pain. And because of this, rising interest rates and a flattening of the yield curve, in my opinion, is not a major reason to be panicked about bonds. But we do have to have realistic expectations about what those bonds can produce going forward. So the scenarios for bonds looking forward, if the long-term interest rate, the medium term, the 10-year stay between 1.7 and 2, which is the sort of consensus view across experts, and this is the base case, then I don't see, we're not going to have losses in 2022 like we had in 2021 in the bond space. I really don't believe it, because I don't think interest rates are going to go beyond 2%. So the best case scenario for bonds is we collect our coupons, and we're going to have between 1% and 3%. Maybe if you've got an aggressive portfolio, you'll get a little bit more, but that's it. Those are your best case scenarios, somewhere between 1% and 3% on that bond component in your portfolio. Bad case, if I'm wrong and interest rates do go up, you'll have another minus. I don't think another -5, but a small minus, and you've got a little bit of a potential asymmetric risk return profile. So you can keep bonds. There's advantages to bonds. They provide liquidity when we need to sell something and buy, if you wanted to increase equity, let's say the opportunity came up. They do provide some ballast to the portfolio, so we can balance the risk a little bit. And the downside is if you sell all your bonds and buy risky assets, then your portfolio is going to be very volatile. And I know a lot of private investors who can't handle that type of volatility. So we need to have some bonds in there, but hopefully not too many, because it will be a drag on performance going forward. Okay, so that wraps up 2021. The takeaway lesson for me is, having come out with discussions with many clients, clients expect their advisors to switch between stocks and bonds based on how they see the market. That's not how this game works, okay? We work within a mandate. That mandate comes out of a discussion about risk and what is your tolerance for risk. Many private clients are on the conservative side of the spectrum, and therefore you have more assets which have more predictable result, bonds, or a narrower range of outcomes. So that's why conservative investors have got more bonds. So the takeaway message is you can't expect your advisor to switch between asset classes. You can have a serious discussion about risk and return and what you can expect. And I do hope that that's happening across Pioneer. Looking forward at 2022, and we're going to just polish the crystal ball here a little bit. And these are the main risks as we see them, okay? Inflation. So we're currently, the headline inflation is over 6%, and which we haven't seen since the 1970s. And this is an unknown, okay? The risk is not so much inflation itself, but what will be the policy reaction to the inflation. This is what we don't know. The Federal Reserve in the 1970s, in order to control inflation, increased the interest rates aggressively and engineered a recession. There were a few painful years in the 1970s in order to bring inflation under control. This might happen, but not in 2022, possibly not even in 2023. I think in the longer term, then the Federal Reserve are going to allow inflation to run above their target, but they're not so soon after COVID are they going to pull the brakes on the economy. So I think that the risk of a policy mistake, the risk of a recession driven by policy is extremely low, but the market will respond to every single word or message sent by the Federal Reserve. So if they start acting like they're panicking, then we could have a bit of a surprise in the market. Another big risk is China. Obviously, in 2021, we saw policy risk. We saw a lot of the big name, the Alibabas, the Baidu, the Tencent. We saw them suffer from policy risk, both from the US side and from the Chinese side. For me, this is less of an issue. I think that China will work its way through these issues. These companies are powerful companies. They're making a lot of money, and I believe they belong in the portfolio. I am a bit concerned about China's position with this Omicron virus. I'm not a virologist or an expert, but what we do know is that China had a zero tolerance policy to COVID. And whenever COVID popped up in China, they would, in a military style, shut down that city. Now, if they don't adapt that policy to Omicron, I believe the whole world will feel that pain. Because if China shuts down cities, the rest of the world has lost control of Omicron, but it seems to be non-critical. The hospitalizations in the developed world are under control, and certainly it's not as dangerous as the previous versions. But if China doesn't change this policy, I'm very concerned, and that is something that I do hope that they recognize and are able to change. Within China, they've got less natural immunity because of the strict shutdown. They've got less access to vaccines. Their vaccine is less effective. They got 1.4 billion people. Can you imagine rolling out the vaccine to 1.4 billion people? I can't even imagine. The other risk or unknown is demand normalization. In 2021, we had a lot of COVID supply issues, right? Every time China shut down a port because of COVID, or some manufacturing firm had cut back their estimate for output, or they had labor shortages, that's on the supply side. On the demand side, the Western world is actually richer than it was pre-COVID. People have made money via the stock market, people have made money via property, people have made money via Bitcoin, people have made money from being rescued by the government, and all that money is being used less on services, less on holidays, and more on goods. So there's a shortage of goods, and we expect this to continue. There will be some normalization, but we're not exactly sure how it's going to unfold. And it's certainly not going to be reflected in the normal economic data that we use and rely on. The good news is that we do expect very strong economic growth. But we're just not sure how it's going to unfold because of this demand normalization. Right, political risk, as I see them, the main ones. And I would like to point out, one should never invest based on your political view. I have clients who are left-wing inclined and who refuse to buy US stock exposure while Trump was in charge. And I've got clients who are right-wing inclined who think that Biden is messing up the US and they don't want US exposure. You should not manage your portfolio based on your political views. The politicians have much less influence than you think. That's aside. As I see the political risks, Ukraine is the highest. I don't think there's going to be a war, but there is some brinkmanship, and this will be a source of volatility. I think Putin holds all the cards. The worst the West will do is economic sanctions, but you can expect some headlines and some noise in this space. Taiwan, I'm not an expert there, but I really don't believe that anything major is going to happen. I certainly don't think China is going to invade Taiwan. More rhetoric. I don't speak Chinese, but I understand that the Chinese have increased their nationalistic rhetoric on Taiwan. Not something that I lose sleep over. Iran, the longer the inaction, the longer the Western world does nothing about Iranian nuclear development, the higher the probability that Israel does something. And that's a risk, particularly for us sitting here. I don't know how to put a probability to that, but it's a risk. And those are the major political risks as I see them. When I look at 2022 key risks, there's no reason here not to be invested. There's no systemic risk. Yes, these things might happen, but they're low probability events. And I think we can continue investing, particularly in the equity space. If inflation stays at moderate levels, this should be good for equities. And these other risks, on the assumption that China doesn't upend the whole world through unnecessary shutting down their economy due to Omicron, on the assumption that that does not happen, then we should be okay. Okay, opportunities for 2022. As I said, not everybody can sell all their bonds, so you need to keep some bonds. I'll talk a little bit about that in a second, about shekel versus dollar. But you can keep some bonds for liquidity and risk management. Within the bonds, we prefer credit risk to duration risk. So that's more risky companies as opposed to interest rate sensitivity. Alternatives. Anyone who's listened to our previous call webinars, we've pushed alternatives. I really believe that everybody needs to start replacing their bond allocation with alternatives. If interest rates stay where they are, they're within the range of alternatives. There are some more conservative ones, there are some more aggressive ones, but if you want returns, you need to allocate money to alternatives. Multifamily property in the USA. Multifamily is an asset class within the property market. I think that this is a well-positioned space to cope with inflation. The leases are short-term. They can increase the prices relatively quickly. If the US trajectory is strong growth, as we think it is, that asset class should do fine. Only problem is it's highly levered. They typically leverage 70%. So you need to be careful. You need to be diversified, but and you need to be with a good property provider, property manager. But I think that that's something to think about. Obviously, super illiquid. You're stuck there until the manager decides he's going to sell it. Within equities, overweight USA. This is a huge debate within my team. Why do we even bother? If we're optimistic about the USA, then why do we even bother investing in the rest of the world? And some of our core beliefs is don't put too many eggs in one basket, even if it is a big, strong basket like the USA. So we are global in our orientation, but we definitely have more money to the USA. On the negative side, the concentration risk within the major indices is starting to bother me. By that, I mean the major companies that you've heard about, Apple at $3 trillion, Amazon, Facebook, Google, Tesla. These 5 companies are bigger than, we've never had such relative concentration within these indices. So that's something to think about why we shouldn't be all USA. But I do think that USA is the most optimistic about look for 2022. We prefer value to growth. The NASDAQ, we have NASDAQ and we're going to keep NASDAQ. NASDAQ today is not NASDAQ of 2000. NASDAQ of 2000 was pure high growth companies. NASDAQ today is 40-odd%, those 5 companies I mentioned, and it is a much stronger index or exchange than it was in 2000. So people associate NASDAQ with growth. Obviously, there are technology and growth elements within NASDAQ, but we're gonna keep that. as exposure. Financials are a play, energy is a play. Energy we might use in our more aggressive portfolios, but financials we're quite happy with. So China, as I said earlier, there's some issues with China. Maybe it was oversold in 2021, minus 23%, quite heavy. The technology sector in China is down even more it's nearly 50% off its peak. So maybe that's oversold, maybe there's value there, but they need to get their way through Omicron, in my opinion. Okay, just to distinguish between Shekel portfolios and global portfolios, we get this all the time at Pioneer. We prefer that the client has two separate portfolios, Shekel reported in Shekel, dollar reported in dollar. When you have the two together, then things get all mixed up and they're harder to understand, but we prefer two if it can be set up that way. Global portfolios, definite preference for equities and alternatives over bonds. Just bear in mind, alternatives are not available for all investors. You have to be a qualified client. The minimum's a factor. Some of them are $50,000, some of them are $100,000, some of them are $1 million minimum per investment. Shekel portfolios, inflation in shekels is still stubbornly low, all right? And the professional view on where inflation is going in Israel is highly contentious. I mean, guys, no one seems to agree on this. I have a feeling that inflation is coming to Israel more than what's represented in the numbers. But currently, a shekel bond portfolio has a little bit more value than a conservative dollar-based bond portfolio. So if you have both, you may want to overweight more bonds in shekels, less bonds in your dollar. Okay, so what do investors do when most of your portfolio is going to underperform your expectations? So you need to increase risk if you can handle the volatility. I know many a client who cannot, and therefore they need to readjust their expectations about return. If you increase your equity, you can average in, you don't have to do it all in one hit. In the long term, if you are genuinely a long-term investor and you have a genuine long-term time horizon, your entry point is less significant, all right? And that's an important point. Are you genuinely long-term or not? Well, we're all people, so at the end of the day. Or you can increase sophistication. This is the alternative investments. As I said, you're compromising on liquidity, complexity, regulated issues, and costs. Alternatives are more expensive, much more expensive than traditional investments. Sometimes there's leverage in these things. And as I said, they're not available to all investors. You have to meet the criteria of being a qualified investor in Israel because a lot of these funds do not have prospectuses in Israel. So as I say, as we allocate more and more money to equities because bonds are not doing, it begs the question, is there a bubble in equities? And I get this a lot from clients. They're saying the stock market is too high, the stock market is too high, okay? We're in a world with negative real rates. So that means nominal rates minus inflation is a negative number, okay? And this cannot be compared to a normal world where you have positive real rates. You expect your valuation metrics to be a bit funny, all right? You expect higher valuation metrics in a world of negative real rates. So on an absolute basis, if you compare some of these valuation metrics on a historical basis, yes, make no mistake, the stock market is very expensive, okay? But on a relative basis, taking into account low rates, and I'll show you a graph in a second which explains this, it's only a little bit expensive. By no means cheap, okay? By no means cheap, but it's not something to be overly concerned about. I still think there's plenty of room to go in the stock market, and we shouldn't be thinking about a bubble. Timing the market based on valuation, if you look at these valuation metrics and you try to buy when it's cheap and sell when it's expensive on a market-wide basis, not a per company basis. On a company basis, you can do it a bit better if that's your specialty. But on a market-wide basis, you can't time the market on valuations. In my opinion, it's a fool's errand. It's an impossibility, and I'll show you in a second one. All right. So the market is pricing in higher and normal inflation. As I said, the market knows the Federal Reserve is going to increase interest rates, short-term interest rates next year. They say from June. Goldman Sachs said from March. I think it could even happen in April. Depends a little bit on the Omicron situation. But for sure, short-term interest rates going up. The market knows it, right? So in a way, these short-term interest rate rises have been priced in. So we shouldn't fear those either. At a certain point, higher short-term interest rates is going to hurt company profitability at a certain point. But I don't think that's yet. So if we go from zero interest rates, and they'll do it in 0.25 increments, so we go from 0 to 0.25 to 0.5 to 0.75, I think the stock market can handle those first three interest rate rises without too much drama. Okay, and as I said earlier, I don't expect the engineered recession to control inflation. I don't expect that for a good number of years. So to conclude, on a broad market basis, I do not believe there's a bubble, and we can continue allocating money there. But as I say, it's not cheap. Just to present that graphically, the blue line here is your price earnings multiple. Okay, I'm an accountant by profession. I hate this metric. It's extremely naive and extremely problematic, but it is the most widely quoted, and it's quite easy to understand. Very simply, how many years profit is represented in the price? How many years of the current company profit is represented in the price? The blue line, you can see the range. This is from 1990. We've got lows in the, I wouldn't look at 2008 specifically, but we've got lows in the low single digits here, somewhere around, double digits in the teens. And we've got highs above 30 at one point. And so the stock market, the valuations were very, very high in 2021, but they came down. Why did they come down? Not because the market sold off, because company profitability was so strong. And that's why these multiples came down from very high 30 to what is this, 25, 26. So we got 25 or 26 years worth of current profit represented in the price. That's not cheap, okay, by any metric. That's not cheap, but it's not something that indicates bubble territory. Ironically, if you thought the stock market was expensive at here, 30-something price earnings multiple, and you thought it was expensive and you sold, then you would have missed this last bull run, because this red line is the S&P 500 index, okay, and it's been trending up pretty strongly while the valuations are all over the place. So this kind of proves that buying and selling broad index exposure based on valuation metrics is a fool's errand, okay? What I prefer to look at is a relative equity risk premium, right? The top part of the graph here, the red line is the S&P index, earnings yield, which is the opposite of the price earnings ratio. So price earnings is price over earnings. Earnings yield is earnings over price. And the green line is the US government 10-year, all right? So if the green line is above the red line, right, and that's represented by this pink line at the bottom, the delta, the difference. If the green line, then there's a relative advantage of bonds over stocks. And if the red line's above the green line, there's a relative advantage of stocks over bonds, all right? So very clear relative advantage of stocks over bonds. And this supports what I was saying earlier. And you can see that quite clearly here. Another thing I keep hearing from clients, the stock market, you'll see it in the newspaper. It happened the other day. Stock market, S&P 500 hits a new record, okay? What does that mean for the average client? They say, oh, hit the record, it must come down, okay? The S&P, this is a graph. The blue line is the S&P price index, and the white line is including the dividend, okay, reinvested all the time. So you can just see how powerful that dividend is over time. This is from 1995 to 2022. The S&P 500 price index, which is the one spoken about in the newspaper, okay, how many records has it broken on its way to 4,600 and something, 4,600? It's broken thousands of records. And my expectation is it'll continue. There are fundamental reasons for that, but it's not something that just because we had a record means that it's going to come down. You can see here's 30-year track record of it breaking records. Okay, my next favorite topic. How are we doing for time? Plenty. Wow, over the 30 minutes. Okay, amongst the last slides. So the currency, the strong shekel is something which is very topical and has hurt a lot of immigrants to Israel, particularly the English-speaking crowd, particularly you guys listening to this call. Okay, there's a few very important lessons here. All the reasons why the shekel is strong now still remain. Okay, nothing is temporary. The Israeli economy is pumping. It's doing exceptionally well. Foreign capital is pouring in and buying shekels. More importantly is Israeli institutional hedging. Okay, as some of you know, the Israeli system forces a huge amount of savings. Okay, if you employ somebody and you pay them a salary of 100, it costs the company 130 about. Okay, there's an extra 30%. Every month, the Israeli economy is saving into long-term, into pension funds, educational funds, severance pay funds, etc. Every month, billions of shekels. The managers of these pension funds look around the Israeli market, and there isn't enough opportunities in Israel for all that money, so they start investing offshore. But they don't want the currency exposure. Okay, they're sitting on billions and billions of shekels. They start investing offshore, but they hedge back. So they're buying shekels to hedge their exposure. This is a big factor in the strength of the shekel. Okay? It's a big factor. How do we know? In March 2020, when the US stock market tanked 35% over a 10-day period, okay? Absolutely tanked. The shekel shot up to 3.75. It was hovering around 3.4. Overnight, it was at 3.7, and then it was there for a week and came back down. Why did that happen? Because of these Israeli institutional hedging. Okay, the stock market went down. Suddenly, they had significantly less dollars to hedge, and they do it on a daily basis. Hey, they hedge their exposure on a daily basis. So the stock market tanked. They lost billions and suddenly had to sell shekels overnight. And that's why the shekel spiked. Now that could happen again, but we're now at we're starting at 3.1, not 3.4. And a shock to the system like Corona, where you lose 35% in the S&P over 2 weeks, that's unlikely to happen. So we may have spikes in the shekel, but we're not. I don't believe we're going to see 3.7 or anything above 3.5. So this means that people who live in Israel and have their liabilities in Israel and their family and their future expenditure in Israel, they need to start building up shekel-based investments. I fundamentally believe this. Other reasons for the strong shekel: gas exports, Bank of Israel intervention. They've reduced their intervention. They're still intervening. Make no mistake, if the Bank of Israel did not intervene in currency, the shekel would be at 2.8. I have that on good authority. Okay, 2.8, that would cause most of the immigrants that I know to be in a lot of financial, really feel the squeeze. So, and then on the flip side, the dollar is fundamentally weaker, right? There's no doubt about it. The US dollar is fundamentally weaker today than it was 5 years ago. So all these reasons, they still exist and they're going to continue. So therefore, I think it's fundamentally important that everybody thinks about their shekel exposure and starts to build that up. Okay, so concluding remarks, conservative investors have a major dilemma, okay, because bonds are just not going to give interesting returns and they need to increase risk if they can live with the risk. If you're not sure what to do, place priority on your risk tolerance rather than on your return demands, okay? It's that sleep well at night feeling. So what if you only make 1% or 1.5% or 2%, whatever the case may be, a low number, then you should be happier with that than watching your portfolio jump up and down. That will cause you anxieties. Okay, I've stated this many times. I favor equities and alternatives over bonds. Stock market records are meant to be broken. We shouldn't be thinking that just because it's at the highest level, it's going to crash tomorrow. Don't let your investment strategy be based on your political views. Be patient on China. Those of you who are Pioneer clients and who have a little bit of China in your portfolios, we're gonna hold on to that for a while, unless we see this Omicron thing go out of hand. Then we might act. And then for all the immigrants or future immigrants or people who have future liabilities in Israel, we highly recommend that you increase your shekel exposure. And that is all. Let's have a look at the questions. Do we use alternative asset classes? Yes, we use all the alternative asset classes. The limitation is whether the client is a qualified client or not, and whether what the minimums are. Unfortunately, some of them have high minimums. So, the portfolio has to be big enough for some of the true alternatives. There are UCITS registered alternative or hedge funds, which are quasi-alternative. They do have some mark-to-market volatility in them, but at least they're not bonds. Inflation, the next question is inflation in the US is about 7%. How do we see the market reaction? I think I covered this one. As I say, I think inflation is going to come down, but it's not going to come down all the way. And I do think we have a long-term problem rather than a 2022 problem. If inflation settles in the 3s or 4s, that's going to be good for equities, bad for bonds. Next question. For non-qualified or US clients, many alternative investments are not available. What can be done to increase the yield without taking additional risk? Right. So US clients is a real problem, particularly in shekels. Americans who live in Israel have got a major problem accessing shekel-based investments. There's tax reasons for this and regulatory reasons for this. I expect to see more alternative products with a prospectus issued in Israel, and that means non-qualified clients can buy it. Pioneer's recently approved a consumer credit lending fund, which has a prospectus, which is available for a relatively small minimum, I think $50,000. That's one way. US clients is a major problem. The world, if they want to buy it from their bank account, the US citizen can buy US property. He's less exposed to taxes than the non-American. So, the whole world of property, multifamily, all those type of things is available to the US investor. However, it's in dollars, not in shekels. Next question. If Evergrande, the Chinese property company, goes bankrupt, which looks likely, do you think it'll have a dramatic effect on the property type investments, and can anything be done if you have exposure to these? Okay, so yeah, I think Evergrande is in some sort of technical bankruptcy. It's huge numbers, and the Chinese government, it's kind of in that too big to fail category. So they are managing it, and they are kicking the problem into touch. Unfortunately, other good companies, we do have exposure to an Asian bond fund, and sometimes the baby gets thrown out with the bathwater, even though those companies are okay. So because of the size of Evergrande, it is affecting the whole Asian credit space. If it goes full bankrupt, which I don't think it'll happen, but if it does, there will be a knock-on effect, I have no doubt, because of its size. But again, I don't think so. Property versus equities. My favorite. So they're not the same. And I believe in property and I believe in equities, and I don't put them one against the other. Property is illiquid. Everyone should have property in their portfolio, in their house, investment property, but you also should have equities. Equities are liquid, and the returns on equities, certainly the S&P, have certainly outperformed property in the past. In a high inflation world, property should be okay. And the considerations of owning property versus equities are very different. Anybody who's owned an apartment for investment purposes knows that you'll have periods where there's no tenant, or you'll have issues with the property. or the property manager, it's not plain sailing. The rental yields in Israel right now are exceptionally low. I do expect rent in Israel to go up, and I assume the question is referring to Israel, but the rental yields are exceptionally low. Okay, so that's that. Let's just have a look. There are a few more questions. Should I buy Bitcoin? Right. So I've tried to understand the world of cryptos, but I actually can't. There's no asset. At the end of the day, there is no fundamental asset. Okay. You're buying a prayer that other people will want this asset, this thing that you're holding, but there is no fundamental asset. So I can't get my head around it. Those who want to access this space, we have, there's a couple of index trackers, one on Bitcoin, one on Ethereum. There's a managed certificate of, it's a mix of, I think, 8 different currencies, if you can call them that. I don't believe they're currencies. And if someone wants a more sophisticated access to this thing, then access to the space, there's a managed solution in that space. We are not doing it on a discretionary basis, but we will respond to a client request who wants access to the space. Look, Bitcoin is down like 30% over the last 3 months, okay? You know, it's a very different attitude to when the volatility on Bitcoin is so huge compared to the volatility on stocks. I don't understand why anyone would bother, but it's not for me. What type of alternative funds do you like most? Wow, that's a bit specific. I personally prefer the managed futures hedge funds, but those are the most volatile ones. Those are not bond replacement alternatives. Those are more equity replacement alternatives. The long short, it's equity exposure, expensive equity exposure. They tend to manage the downside a bit better, but they'll never keep up with equities, the long short guys, in my opinion. And that's all. Okay, great. Thank you everyone for the participation. If there are any follow-up questions, you can reach out to me or to Pioneer via your relationship manager, and we'll be happy to answer. And on that, I went way over time, but thank you very much, and we shall be in touch. Good evening.